Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Objectives of Monetary Policy. Monetary policy, executed by central banks, plays a crucial role in maintaining economic stability and fostering sustainable growth. The primary objectives of monetary policy are to control inflation, manage employment levels, stabilize the financial system, and influence interest rates to achieve an optimal level of economic activity. These objectives are pivotal in shaping the economic environment and ensuring the health of the economy. Understanding these objectives allows us to appreciate the intricate balance central banks must achieve to navigate complex economic landscapes. Controlling inflation is perhaps the most widely recognized objective of monetary policy. Inflation, the rate at which the general level of prices for goods and services rises, erodes purchasing power and can create significant economic distortions. Central banks aim to maintain a low and stable inflation rate to ensure price stability. According to the International Monetary Fund, most central banks target an inflation rate of around 2%. This target is considered optimal as it encourages consumption and investment without the negative effects of high inflation. For instance, the Federal Reserve in the United States and the European Central Bank both adhere to this target, utilizing tools such as open market operations, discount rates, and reserve requirements to influence inflation rates. Managing employment levels is another critical objective of monetary policy. Central banks strive to achieve what is known as full employment, where all individuals willing and able to work at prevailing wage rates can find employment. The relationship between inflation and unemployment is often illustrated by the Phillips curve, which suggests an inverse relationship between the two. However, this relationship is not always stable, and central banks must carefully balance their policies to avoid triggering inflation while reducing unemployment. For example, during the 2008 financial crisis, the Fed implemented unconventional monetary policies, such as quantitative easing, to stimulate economic activity and reduce unemployment rates, which had soared to over 10%. Stabilizing the financial system is an essential objective that has gained prominence, especially after the 2008 financial crisis. Central banks must ensure that the financial system operates smoothly, mitigating risks that could lead to financial instability. This involves overseeing banking systems, regulating financial institutions, and acting as a lender of last resort during financial crises. The Bank of England, for instance, has a financial policy committee dedicated to identifying, monitoring, and addressing systemic risks to protect and enhance the resilience of the financial system. The crisis underscored the importance of macroprudential policies aimed at safeguarding the entire financial system rather than individual institutions. The interplay of these objectives often presents central banks with complex trade-offs. For example, efforts to control inflation might conflict with the goal of reducing unemployment. This dilemma was evident during the stagflation period of the 1970s, when high inflation and high unemployment occurred simultaneously, challenging the traditional Phillips curve framework. Central banks had to innovate their approaches, leading to the adoption of more flexible and forward-looking strategies. Additionally, global economic interconnectedness adds another layer of complexity to monetary policy. Central banks must consider international factors such as exchange rates and capital flows, which can impact domestic economic conditions. For instance, the Fed's interest rate decisions can influence global financial markets, affecting emerging economies through capital flow volatility and exchange rate fluctuations. This necessitates a coordinated approach among central banks to address global economic challenges and ensure stable growth. Moreover, the advent of digital currencies and advancements in financial technology present new opportunities and challenges for monetary policy. Central banks are exploring the potential of central bank digital currencies to enhance the efficiency of payment systems and broaden financial inclusion. The People's Bank of China has been at the forefront of this development with its digital yuan pilot, highlighting the evolving nature of monetary policy in the digital age. In conclusion, the objectives of monetary policy controlling inflation, managing employment levels, stabilizing the financial system, and influencing interest rates are critical in shaping economic stability and growth. Central banks must navigate complex trade-offs and adapt to evolving economic landscapes to achieve these goals. By understanding these objectives and the tools available, we can appreciate the central bank's role in fostering a stable and prosperous economic environment. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UXL, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.